Rokt helps retailers make more of every transaction. When someone is already buying online or in-app, Rokt makes it possible to show relevant ads and offer content in that moment, like subscriptions, upgrades, or loyalty perks. So instead of interruptive advertising, customers see something more useful and more timely. For retailers, that creates more value from the transaction. For customers, it creates a better experience. That's Rokt, making every transaction more valuable. My guest on this flight of the Retail Pilot is Neil Saunders, Managing Director and Retail Analyst at GlobalData Retail, one of the industry's most trusted voices on global retail, consumer behavior, and brand performance. He leads GlobalData's retail practice and advises major retailers, brands, landlords, and financial institutions worldwide on market landscapes, strategy, and future growth opportunities, translating complex data into clear, actionable insight. A sought-after commentator in the media and on conference stages such as NRF and Shop Talk, he regularly decodes earnings, forecasts, and shopper trends for executives and investors. Before Global Data, Neil worked at John Lewis Partnership on store planning, e-commerce development, and retail systems, grounding his analysis in real operating experience. He lives in both Scottsdale, Arizona, and Maui, Hawaii. Neil, welcome to the Retail Pilot.
Thank you very much for having me. It's a delight to be here.
Me, like everyone else, I'm sure, enjoys reading all of your updates on LinkedIn. And if you're not following Neil on LinkedIn, you're probably missing a lot of what's happening out there in retail. Neil does a great job covering companies and also giving you a perspective on company performance and also retail in general. So we're going to dig into a number of topics today. Super excited to get your perspective because, as always, there's a lot happening in retail. Let's start at 30,000 feet. Over the past 6 months, the tone in retail has shifted again. We've had ongoing price hikes tied to tariffs and, frankly, the price impact of the Iran war layered on top of a consumer who's already dealing with higher costs almost everywhere. From your vantage point, what's changed most in the narrative from retailers and consumers over these past 6 months?
Well, I think that the thing that's changed the most is also the thing that's been present for a long time for both retailers and consumers, and that's uncertainty. We've lived with uncertainty really since the pandemic, but certainly over the past couple of years that has intensified. And the Iran war just heaped more uncertainty on top of what we'd already got. And I think it makes it very difficult for retailers to plan. It makes it very difficult for consumers to understand the trajectory of the economy or what's happening to prices. And all of that is extremely unhelpful for either household financial planning, but especially for retailers' financial planning. And I think actually, in the wash, the consumer has done a very good job. They have remained remarkably resilient despite all of these problems. But even though we're seeing that good retail demand, I think the thing that's changed from a retailer perspective is okay, we're still getting some sales, but how do we translate that into profits? How do we translate it into really good earnings? Because the cost side of the equation is very tight. The operational side of the equation is tight. The Iran conflict has exacerbated that. And I think it's just put more complexity onto the retailer at a time when they really don't need this. So it has been extremely unhelpful, but in a strange way, we've sort of managed to muddle through it.
And you talk about the higher costs, the impact on the retailers, specifically within the P&L. What do you think, or where are you seeing that hit on the P&L? How is it coming through in terms of whether it's margins, shopper behavior, which isn't on the P&L, but certainly we look at it in terms of traffic and conversion. Where are we seeing the pressure most acutely?
Well, I think we're definitely seeing it in margins because retailers have faced a whole cocktail of cost increases, and the equation that they're having to balance is whether they pass those things across to the consumer or whether they absorb some of them themselves and try to find operational savings or take a hit on margins. And I think the answer for most retailers is they're doing a combination of things. They are sometimes putting up prices, which is unhelpful for the consumer, but oftentimes because they know the demand environment is very challenging, they don't want to pass everything across because they fear losing sales and market share. So they're looking inward, trying to make savings where they can. Sometimes they're saying, okay, let's take a short term hit on margins because honestly, losing a bit of profit is better than losing customers. We can deal with the profit side over the medium term. It's much more difficult to remedy a lost customer and win them back. So I think we are seeing that hit on margins and net income for some retailers, but it is a calculated decision that some are making.
It, it's interesting when you talk to different brands or retailers. I always try and get to what percent of the cost increases were passed on to the consumer versus what percent were absorbed. If you had to take a swag at that, specific to the tariffs, which were the biggest hit, and yet now we're also seeing an increase in
Mhm.
um, import rates, fees, transportation, et cetera. What percent of the pie did the retailer actually pass on to the consumer through pricing, and what percent did they actually eat?
Yeah, it's a very good question, and obviously just has to be done on an average basis across all of retail. I think really the amount that was passed across to the consumer was probably in the range of 40 to 45%, and the rest was absorbed. And with the absorption, some of that was counterbalanced by retailers changing where they source supply from. Some of it's counterbalanced by savings that they managed to find elsewhere. But this is one of the interesting things because you can look at the impact of tariffs now and you can say, well, yeah, it was very unhelpful to inflation and we're seeing that come through. But actually, it's not been as bad as feared. But of course, inflation was only one of the places where this comes out. The other side where it comes out is on profitability of retailers. And I think there has been something of a hit there. But it also comes out in jobs because even if a retailer is maintaining profitability, maybe they've cut some jobs to do that, to offset tariffs. So the impact of tariffs is just not helpful for US retail. And you can't just look at inflation to say, okay, that's where it's been unhelpful. I think it's been unhelpful in a whole variety of different places. And retailers have done a very good job of trying to manage that. But most of the trajectories for all of those things is negative. And that's why we haven't seen as bad a hike in inflation as perhaps we suspected at the beginning of it because of that creativity. But it doesn't mean to say that it's a benign thing or that we've escaped without consequence, because we really haven't.
You mentioned earlier the resilience of the consumer, which we're hearing a lot about right now. And on the one hand, it's somewhat surprising for all the reasons you just mentioned. When you think about this K-shaped economy and those who are winning, whether it's at the upper end of income, those who are realizing some of the benefits of what's happened in this fairly robust stock market versus consumers who are lower to middle income who are struggling. Where do you think the K shape really is? And is the success more at the top, or are you seeing a resilience that's consistent from top to bottom?
Well, it's a very interesting question, and we hear a lot about the K shaped economy. And the honest truth is, in terms of retail sales growth at a value level, every broad income group, lower income, middle income, and higher income, has contributed to the increase in retail sales. All have grown the amount that they spend year over year, and they've done it for a number of years, including last year. And that sort of jars with some of the narratives that like only the growth is only being driven by the top. But look, this isn't necessarily a good thing. The reason everyone has grown in terms of the amount that they spend on retail is because they've had to, because things cost more and you can't really cut too many groceries and essential items. It interestingly comes out in volume where you see that divergence. So most of the volume growth is being driven by the higher income consumer. The middle income is growing a little bit, The lower income consumer is definitely not, because they've had to cut back in the number of things that you buy. And that's really where the tension comes in. It's not necessarily in the value, it's in the volume. And no one really wants to cut back. Generally, people like to buy more things. It's exciting to consume. But they've had to, and people have had to trim their cloth according to their new financial situation. And that financial situation for the lower income household is a lot more constrained. And then you see it come out in where they spend. The proportion that the lower income household spends on, say, groceries or essentials has gone up as a proportion of their spending and even as a proportion of their income. So when it comes to that discretionary spend, they're giving even less growth in volume terms to retail. So there's definitely a K-shaped economy there. It's sometimes a bit hidden in the numbers, but really it is very much present in terms of the nuance of where that volume growth is coming from.
So, if you had to summarize where the consumer is, aside from the headlines around resilience, are you feeling that the consumer is really in a good place going into the back half of the year?
I think the consumer is in a surprisingly good place considering everything that's going on. And I think that this first half of the year has been very robust. And quite honestly, a lot of that is because there have been higher tax refunds and it has acted as a shot in the arm. The concern is, how long can you keep this growth and this momentum going for the consumer? And I think that we see the impact of tax refunds fade in the second half. We also, I think, start to lap some tougher prior year comparatives and numbers. So I think there's a danger that things do soften down in the second half. I don't think it's disastrous. It's not necessarily going to be a recession unless something surprising comes along and pushes us into that place. But I think we have to be very careful to not draw from the first half false optimism and say, look, everything is absolutely great, because it has been a really exceptional, period in terms of growth. But I think we have to be very, very cautious about how that turns out as we go into the critical credit trading period, which is obviously the golden quarter.
Let's get down from a macro level to more of a micro level and talk about verticals and sectors. When you look across the retail landscape right now, which verticals are clearly winning, and who feel like they're running downhill with the wind at their back?
I don't think there are any real surprises here. The sectors that are doing well are often value oriented, like off price, for example, is still on fire. Resale, secondhand is still on fire across all of the different categories that they operate in. I think we're still seeing some really good gains from the value oriented players in grocery, like Walmart, like Aldi, for example. So anything that has that value anchor, I think, tends to be in a much better position. And as I say, it's not surprising given where the consumer is. I think where we're seeing more struggles isn't necessarily linked to the sector or the channel. I think it's linked to the value proposition. And I think where we're seeing the challenges is where the value proposition isn't clear. Now, often with the value retailers, it's super clear because it's anchored around pricing plus some other features. I think in the murky middle, where you kind of have prices that are okay, but they're not great, but the other aspects of the value proposition, whether it be convenience, quality of range, the actual quality of the product, the customer service, where you see all of these things, I think it's a lot more difficult to generate that growth.
Neil, on the flip side, where are the headwinds strongest? Is it discretionary apparel, home, big ticket electronics, mall based retail, or all of the above? What's at the top of your challenged list?
I think just from a sector or category point of view, there's definitely some challenges with big ticket because big ticket often needs financing and obviously interest rates are much higher. Sometimes it's linked to moving home and people refurbishing things, and obviously the housing market's in the doldrums. So we definitely see some challenges there. I think where the challenges are more broadly, though, is often with legacy retail models that really were doing okay before some of these challenges. But actually, what they've found is now the consumer is more discerning, is much choosier about how and where they shop. the value equation doesn't quite balance anymore. And what's unfortunate is a lot of those players actually need to put in a lot of investment to bring it back up to scratch. But obviously, if the sales aren't doing well and some of them have or carry debts, it's very difficult to reinvent. So, actually, I think broadly, it's less often about sectors and it's often about the underlying strength of the proposition. And that's what we see. Often, those on the front foot propositionally are getting stronger. They're doing okay. But that have been on the back foot and are not remedying it, they're actually getting weaker. So I think it's more about where retailers are in the life cycle that matters now than necessarily the category that they're involved in or the type of retailer that they are.
All right, let's get a little bit more specific now. We'll talk about denim as we're going into Q3 as maybe the most competitive we've seen in decades. Walk us through that. What's driving this level of competition and who's best positioned in that fight? Levi's, Gap, Abercrombie, American Eagle, Urban Outfitters. How do you rank the field?
Yeah, it's a great question. So I think with denim, there are a number of consumer trends, including celebrities getting involved in the category that have really propelled the whole Western wear arena over the past couple of years. And we're seeing that continue. I think the silhouettes, the shapes, the shades of denim, those things change with fashion, but there still is an interest in denim. What I think is interesting is how the players are leaning into that evolution and how they're changing. So we're seeing at the moment from almost all players a lot more emphasis around soft denim, soft fabrication, because that's where the market is starting to move. What I also think is really exciting, and I think this does answer part of the question as to who's at the top, it's Levi's. And I think that what's interesting is they are moving from being a player that is anchored very much around denim to being anchored around denim, but building a whole lifestyle proposition around it. So it's like, hey, yes, come to us for the denim. We have so many more denim items now. It's not just about the jeans, it's about tops, jackets, dresses, all sorts of different things. But then they've said, okay, but we're also selling things that team up really well with denim. So you can get your denim from us, you can refresh your denim, but you can buy all of these other things to create whole outfits. It's basically creating a lifestyle proposition. And I think that's really important for them because, their denim's good quality. It lasts for a long time. People don't necessarily need to keep buying it other than for fashion and style changes. So by spinning it out into being a much wider lifestyle retailer, they've got a lot of extra growth from existing customers. They're pulling in new customers, and what's interesting is as people are buying the other things like the tops or rugby shirts or other bits and non denim bobs that Levi's are selling, they're also saying, hey, I'll refresh the denim to go with that as well. So they've actually, by extending beyond the core, managed to get incremental sales. And they've managed to drive the core as well, even further than they were doing, which I think is a really interesting strategy. And that's why they're performing incredibly well at the moment.
Yeah, it's funny you mentioned Levi's, but I think you go back to the Beyonce campaign that they launched, maybe it was a year ago, that really, from my perspective, helped them turn the corner. I think they had some good momentum, but it really made them more noticeable. And it also put them on par with the other big players such as Gap and American Eagle, who were leaning into celebrities and leaning into collaborations. Those have been very important for attracting customers, creating energy, brand excitement, et cetera. Um, I don't know how much the brands are spending this quarter, but typically these big brands spend anywhere from 3 to 4% on advertising budgets. But you have to think that the collaborations will continue. Celebrity, the commercials, they've all been pretty good and pretty exciting and fun to watch, from Sydney Sweeney to fill in the blank. But there's a lot of entertainment happening. Certainly, Gap is leaning into it in a big way. How do you see that impacting the customer and the brands?
Well, I think it's really important because I think one thing we are seeing more of, especially with the younger customer, and the younger customer, for example, has driven a lot of the growth that Gap has seen. The younger customer wants the product, they want the brand, but they also want a cultural connection. It's really important to them that the things that they're buying just aren't random products. They kind of want it linked to the celebrity or the wider moment in culture. And I think all of those brands, American Eagle, Gap, Levi's, really get that and have really leaned into it. But Gap has done an especially good job. I think when Richard came in, one of the first things he said was, it's really important that we start to build a cultural currency, cultural connection, especially within the Gap brand, to really get the younger consumer enthused about what we're offering. And I think honestly, some people were very skeptical of that because culture can be a very woolly concept. But it has proved to be exactly right because Gap has attracted a lot of new customers, especially from those younger cohorts, precisely because of what it's done with celebrities, what it's done around events, its advertising and marketing with headline celebrities. And people have taken a fresh look at it. And when they've looked at it, they've liked what they've seen and then they've bought stuff. And I think it's just almost like renewed the relevance of Gap. And that was one of the problems with the Gap brand in the past. It just didn't seem relevant to people. And now I think that's beginning to change, which is why we've seen such good comps from the Gap brand for quite a number of quarters.
Yeah, I give Mark Breitbart a lot of credit leading the Gap brand and also really focusing on the collaborations, curating the collaborations in a way, as you said, that does attract younger customers, whether it's Doen or it's Love Shack Fancy or it's Mad Happy. They continue to do this as if they were an art gallery curator releasing new collaborations. Feels like every other month, but something fresh, which continues to drive traffic, discovery, and new customers. And I think they're doing a great job, and that's been a big part of their turnaround. Um, let's pop over to athleisure. Interesting category. You know, the darling for many years was Lululemon. Now they're getting squeezed, pun intended. When you look at that landscape and you have Alo, Viore, Fabletics, others are aggressively going after the customer. How do you see the segment today in terms of saturation versus runway? And who's genuinely growing and who's just taking turns on the same shopper?
I think athleisure is in a very different place to where it was 5 years ago. The market is more mature than it was. And obviously, if it's a more mature market, it's very difficult to grow. The fashion cycle has changed somewhat. We were all into comfort and wearing things that felt good. That's still the case to an extent, but people are looking at more structured, more stylish clothing, more fashion forward clothing. So it's kind of gone off the boil from that cultural point of view. And of course, at the same time as this slowdown has happened, there are more mouths to feed because everyone, off the back of Lululemon's success, has expanded into this market. And you have growth from Alo, you have growth from the smaller brands like Viore, but then you also have players like Abercrombie and Fitch that have done your personal best. All of these brands have grown into the market, so there are more mouths to feed at precisely the same time as the market is slowing down. And what that means is basically someone has to take a hit somewhere. And it's not really surprising that Lululemon has taken the hit because they are the biggest. And therefore, there is more to nibble, there's more to attack, more surface area that you can erode share from. But they also did the one thing that they needed to do more of during this slowdown. They really took their eye off the ball in terms of innovation, quality, really thinking about the range, being on the front foot. And that's just led to a bit of inertia from the customer, and the customers drifted off to other brands like Viore. Lululemon is still huge and it has a massive international growth opportunity. But there is a sense increasingly that in the US and North America, they've kind of hit their peak. And I think it's for them to show how they can move beyond that and actually generate some incremental growth.
The challenge that Lulu is having as well, and it has to do with the age of the brand, just the look and feel of their stores. From my perspective, I think the stores have grown a bit tired. They don't look as fresh as they once did. And when you compare them to whether it's an Aloe who's highly curated, more focused on sets and coordinates, if you will, or Viore, who's got a very inviting atmosphere, very California laid back, fresh and light. They're just better places to shop. So there's a fair amount of CapEx going to be required to go back into Lulu and really update the stores. I think it's necessary to start to show some change and keep pace with where the customer's going.
Yeah, I completely agree with you. I think the word that comes to mind for me with Lululemon stores is sterile. I mean, they didn't used to be. I think they were once quite cutting edge, but they've not innovated and they've not shaken it up. And the stores seem very boring. And the products as well aren't that innovative now. So the combination of the two things, slightly off-key products and a kind of boring environment, do not make for happy bedfellows. And I also think that they try pop-ups, for example, in certain markets. And I get that they want to try before they open a full store. And honestly, the way some of those pop-ups show up, they're atrocious. I mean, they do not look like a premium brand, and obviously Lululemon charges pretty full prices. And I don't think you can get away with that in this market. And I think that even the fact that someone at Lululemon thinks that's an acceptable way to show up, even when you're testing a market, is worrying because it's absolutely not good enough. Because to your point, everyone else in the market, or most other players, are really on the front foot in terms of their formats. They're really trying to lean into that experience and keep it fresh and interesting. So Lululemon, I think they've just rested on their laurels too much, and they really need to inject more energy into the product, but also into the experience and sense of place of the stores.
I'm going to put you on the spot, Neil. Where are you shopping for your active wear?
So I personally, I tend to shop at Vuori. I quite like Vuori. I like the softness of some of the fabrics. I like the kind of store environment. It's very welcoming. I have bought stuff from Abercrombie and Fitch, your personal best, and I think that that is a great line. A lot of the stuff is really nicely constructed. It's really good quality stuff. But actually, the last piece of athleisure, very loosely form that I bought for cycling, I go cycling a lot, was actually from Macy's, and it was a Spain football top to show my support in the World Cup because I didn't want Argentina to win.
Wow. Well, we'll have to talk about that later. Well, good pivot into the next category. Let's talk a little bit about department stores and luxury. I mean, Macy's, under Tony's leadership, seems to be doing quite well, especially Bloomingdale's. Saks seems to be on a comeback. Now that they've gone through their Chapter 11, it seems like they've gotten their financials together. They've closed some stores. Give us from your perspective, the lay of the land, the health and wellness of department stores, as well as the luxury sector within department stores.
So I think department stores are one of the most interesting bits of retail, because I think when you can look at them in two ways. You can look at the structural challenges. Fewer people are shopping at department stores. It's a very difficult business model to get right because they're huge stores. They have huge capex, huge overheads. You know, they're being challenged from mass merchants still and online and all the rest of it. That's been true for years, and that's why there's been a decline. But actually, the more optimistic reading is that department stores are probably in a better place today than they have been for a very long time, and the reason for that is because people have come into department stores like Tony at Macy's, and they've said, okay, the biggest problem we have is that we have not been showing up, especially in our physical stores, in the right way to the customer. We've let the rot set in. We've not put our proposition out there clearly. We've not invested in service. We've not been investing into the stores. And they are really actively trying to remedy that. And I think it is working. It may not be working in the most dramatic sense, and they may not be regaining all the share that they've lost. And I think it's too optimistic to assume that they would. But the numbers are looking better because they're trying to connect with the customer more. And the same applies to Dillard's. I think they've always done a slightly better job, but they're still on the front foot. I think even JC Penney, whilst the numbers aren't great, they are trying to be more disciplined. They are trying to strengthen the proposition. Obviously, we've had Saks that's been through a terrible time because of the really lousy financial game playing that they did under previous management. They're now back to being run by a merchant. Jeffrey is a merchant, and I think that will help them. I think they've got a very difficult road ahead of them. But I think the difference is now we have some of the right people in place who actually understand what stops the rot, what drives performance, and hopefully what can take these businesses forward. And I think that's why they're in a more optimistic position than they've been for quite some time.
It's interesting you mentioned J.C. Penney, and I know they've been working hard to make that turnaround happen. But then you look at someone also like Walmart, who's out there very focused now on fashion and doing a great job in that sector, and also going after customers that are earning over or household incomes over $100,000. I gotta believe they're putting a lot of pressure on whether it's Kohl's, J.C. Penney's, yeah, those companies in particular, Target, obviously, to some degree. What do you think about what Walmart's doing, and how is their positioning that's sort of shifting, impacting the others that I just mentioned?
Well, first of all, Walmart is a fantastic retailer. I think Walmart is obviously a huge company, as we all know, but it doesn't behave like a huge company and it never has. It behaves like a small entrepreneurial retailer, which is why they're usually on the front foot. They've been fortunate as well. I think trends have been on their side. People are like, hey, I don't want to spend all of this money on grocery. It's super expensive. Where can I get better, sharper prices and just bring down my expenditure? And a lot of them, including higher income consumers, have turned to Walmart. A lot of it is Walmart online, admittedly, but Walmart has still made gains and it's enlarged the customer base. I think what they're doing now is they're saying, right, okay, how can we get more from these customers? How can we edge up our credentials in fashion, in beauty? How can we do more on higher end food? Higher end, obviously, relative to everything that Walmart does, which is why you've seen innovations like the Better Goods brand in food. It's why you've seen much more innovation in fashion. It's why you're seeing stores show up better in the market. Because I think what Walmart has realized is look, we can still have great everyday low price credentials, but we can push some of these higher income consumers a little bit further. And actually, some of our lower income consumers are also interested because wanting to have great prices doesn't mean that sometimes people don't want to trade up. People always trade up and down, whatever income spectrum they're in. And I think Walmart's just got a little bit more confidence to say, well, we don't always have to do everything in a super basic way. Sometimes we can play in a bit more of a bougie space, and it's working for them. And I think online, in stores, the marketplace, across that piece, I think we're seeing them take more share, not just in categories per se, but actually in some of those kind of middle spaces within the categories in terms of the price points and the brand positioning.
I mean, you can buy an Hermes bag on Walmart's
Yeah.
website. It's secondhand, but it's Hermes, and you're spending over $35,000. Who would have ever thunk that Walmart would be selling you or me an Hermes bag? Um, let's touch on. I just want to circle back on department stores for a second. Viability. A lot of discussion are department stores still viable? Is there a future? Where do you weigh in?
I'm unequivocal on it. Yes, there is a future because when you think about a department store, what is it? It's a store that sells lots of different things under one roof. Well, a mall is basically a big store that sells lots of things under one roof. Walmart is that. Target is that. I don't think there's anything conceptually wrong with the idea of department stores, and therefore I think that there is a role for them to play. I think the challenge is in crafting what exactly that role is and how they show up in the world versus others. And I think as long as they focus on adding value and creating something that's quite meaningful from the department store experience, I think there's definitely a future for them. And I think they're headed in that direction. Like Macy's is doing more with private labels because that's what differentiates it. It's making the delineation between brands within the fashion department clearer. So the shopping experience is easier. It's trying to say, okay, how do we elevate home so that the person that comes in for fashion wanders into the home department and then they end up buying something? I think all of this operational tightening is what produces better success. So I think there is definitely a role for the department store. The question isn't really whether there's a role or not. It's not whether they'll become extinct or not, because I think the answer to that is no. It's how big a role. That's really the question. It's like, how many stores do you need to shut? Do you need to shrink down some of the existing space? Those, I think, are the real challenges rather than that existential question of whether they will or can exist or not, because I think they definitely can.
Yeah, to your point, I mean, you look at Nordstrom, they have about 100 regular price stores. Their growth is going to come from the rack. And they've said that in statements quite often. Um, y- you look at Macy's looking at off price and Saks actually walking away from their off price segment, which leads us to off price, which you talked about earlier. Um, it seems like it's between TJ Maxx and Ross. I mean, that's all you really hear about. Those are the two, to me, clear winners. What are they doing operationally and or from a merchandising perspective that keeps them vibrant?
Well, I think they both have some things in common, and I think that TJX is much more established in doing these things, and it's been doing them for a long time. The first one is absolutely fantastic buyers. People sometimes think that like off price is easy, you just mop up excess stock and you put it in the stores. It really doesn't work like that. Actually, if you speak to buyers in off price, they have a sharper read sometimes than buyers of full price mainstream stores. They know absolutely just by looking at stuff whether their customers are going to buy it. They know the quantities. They know whether something is a good deal or not. They know what brands they need. They know the mix. It's actually a very complicated business model. And those buyers are super plugged into the consumer and they're super plugged into the marketplace of where to find these things to sell. And of course, some of it they do have made for them. It's not just all excess stock. So I
Yeah,
think key model.
that's interesting, Neil, because I think people have some misconceptions. What shows up at TJ Maxx or Ross stores, it's not all that failed at retail, and they're taking a second bite at the apple. Break down for us, if you could, what percent of what's in those stores is actually bought, or their special makeup units, SMUs, as the industry calls them. What percent is actually ordered and purchased through a variety of different vendors versus what's actually a strategic buy from a retailer or brand that's failing?
Well, actually, the bought for rather than the kind of excess inventory part can be quite high. I mean, it can go up to 50, 60% sometimes of the mix. They're often special buys. Sometimes they're things that are bought because factories have excess capacity and want to put things out. So it is actually quite high, but obviously it still needs that customer acceptance. So again, you can't just go for any old thing and just manufacture bits and bobs to fill up the store. You've got to really think about how that sits versus to the things that you're buying more opportunistically in the market. And the buyers have a very good handle on that. The other thing I think they're really good at doing through the opportunistic buys and the more planned buys is creating newness. I mean, you go in and you see new things. I mean, you can go every week and you will find new things in there. And they know the frequency with which they need to drop that newness into the store to keep the customer coming back, which of course drives the traffic, but it also drives the buying. And that's another part of the success story. It's not just because the prices are competitive, it's also because there's always a reason to go in, there's always a reason to look. And if you're going in, you can convert someone. If you're not winning that traffic as a retailer, doesn't matter how good you are, you're not going to convert. So the whole model is operationally, I think, very, very tight, and it's geared very heavily to drive sales through a lot of different dimensions.
Any rumblings? I mean, I know that TJ Maxx is beginning to look at online. I'm not sure Ross is. Will that become anything for them, or will it always be a very small part of the business?
I think online can be part of the business from an inspirational point of view, showcasing products, maybe doing stuff with live streaming and those kind of things. People love the idea of like, hey, this is a bargain in store. I don't think they'll get into online in a serious way for two reasons. First of all, I don't think, especially Ross, that they're at the stage they need to. I think they still have headroom for physical expansion. TJ Maxx, probably less so in the US, but certainly globally, they have room to do it. I also think it sort of breaks the model. I mean, if you can sell stuff online. You don't need to visit stores as frequently. Stores are great at driving impulse purchases. Online is less good at doing that. And obviously, the margins and the mix is very different. It does cost more to fulfill online. You will probably get a lot more returns. And I think it just breaks some of the financials of the business model. It's a bit like Primark have never really got into it in a serious way, although they may have to change that. And I think that also applies to the off price players. When you hit that ceiling, you can never say never because maybe you have to look at something else. But I think for the moment, they're quite satisfied with the pipeline of physical expansion and the growth from that format.
You mentioned Primark. Tell us a little bit about Primark and whose market share that they will impact most as they begin to grow their footprint in the United States.
Well, Primark is interesting because I think that they are still in the foothills of their US adventure. I mean, it's been over 10 years really since they came to the US now, and they don't have tons of stores, but that's deliberate. They have expanded very gently because they've wanted to learn. They are also extremely picky about locations. They know what locations will work. They know it needs to be next to a car park or parking lot, or it needs to be in a certain position in the mall. And they will only take the opportunities to expand where the space is good. Because if they don't, they will have stores that are suboptimal. But it's working. I mean, the business is growing, it's attracting customers. The new store in Manhattan, for example, down near Herald Square is doing really well. It's over plan. It's attracting customers in, and they are pulling market share. They're doing it from a variety or taking it from a variety of different places. In certain malls where they are, it is coming from J.C. Penney. We know that where there's an overlap, that's happening. It's coming a little bit from Target. It's coming from Walmart to a certain extent, although Walmart is making up ground elsewhere, so you don't really see it in balance. It is coming, I think, from some of the mainstream apparel retailers as well. They've obviously taken and mopped up a lot of share from players like Forever 21, which have exited the market. So it's coming from a whole variety of different places.
Uh, Before we go on to the next category, I want to put you into the investor's seat for a moment. If you had to place your own capital in a basket of retail names today, which sectors and or which brands across luxury, mid-market, and value would be in that basket and why?
Yeah, so I think a safe bet, I think, would be Ross. I
Is
say Ross rather
that
than
Ross
TJ because
is that Ross over TJ's right now, dollar for dollar, you'd go to Ross over TJ's?
it is Ross. It's not because TJX is bad. It's just TJX has done a lot of the great things that have delivered growth, and I think Ross is starting to discover those. I mean, Ross's comp last quarter was exceptionally good. I don't think they're going to maintain that, but things like the better product mix, the marketing mix, the ability to pull in more higher income customers, which traditionally they've not been as good as TJX at, that's all upside for me. So I think Ross is definitely on a trajectory of doing better. I will take a risk and I will say Target because I think Target hasn't been doing well, but I like what I'm hearing. I like what I'm seeing from Target. They're in the early stages of recovery. And I think if they keep going, they can perform better. They can grow the sales line. They can get back to profit growth. And obviously, that's all going to be helpful for the share price. It's a long term investment. This is not going to happen overnight, but I would put them in the basket as something that I think has potential to do a lot better in terms of share price and obviously underlying performance. A safer bet, I think, would be Walmart because they're just doing so much good stuff at the moment. I think there's still upside for them. I think they're superb operators, and I think they can still drive a lot of shareholder value through that business, especially from online and digital commerce.
Well, today is Thursday, July 23rd that we're recording, and I think Walmart stock is probably around $105 a share, almost 20% off its high. Could be a good buying opportunity there. What about one of your darlings, Aritzia, or what about talk to us a little bit about who you'd pick in the denim space? Who would you add to that basket?
Well, I like Levi's for all the reasons we've discussed. I just think Levi's strategy gives them a lot of growth. And that is the interesting thing. I think you're looking at retailers where the core is good, but actually they have that growth story. And I think Levi's core is excellent, but they do have that play of, hey, we're getting more into lifestyle and we can really grow that. And that's taken them from a retailer that's quite dominant in a category to a retailer that remains dominant in the core, but then has all of this runway to do extra things. Aritzia, I like as well because Aritzia has got a very good pipeline of expansion for the US. They've got a lot of locations they can still grow into. But the existing locations that they've had open for a while in the US and to a certain extent Canada as well, they're comping very nicely. And they're just doing a great job on the product, a great job on attracting and retaining customers. And of course, that's before you even get into further international expansion across the globe. So I think they're a great retailer. And yes, they're definitely a good investment story.
They are just killing it. I mean, the comps, the numbers, it's enough to make every other retailer sick. I don't know what else I could say.
It is, and the thing is as well, the comps are obviously the result of what they're doing, but you see it, and you'll see it as well. When you go into a store, there's energy. The customers are in there. They're not just in there casually, they are really engaging with the products. You hear people, "Oh, this is great. Oh, I will buy this." There's real buzz around that. I mean, we had one open not so long ago in my local mall, Scottsdale Fashion Square. It's one of the best stores in the mall in terms of how it looks and feels, and it's still one of the busiest stores in the mall, even though it's been open for a little while now. And that energy, I mean, that's the confidence from the consumer.
What about Inditex, the owner of Zara, Pull& Bear, Massimo Dutti, Bershka, and H&M, global names that have been here. You add Uniqlo to that list as well, that have made very strong inroads into the U.S. market. How do you see those 3 faring going forward, and where would you place your bet if you had to pick one of those to put into your basket?
Uniqlo I love because it's just working. I think that elevated basics, I think just the way in which they merchandise the stores, the price points are good. It's the proposition again, it's strong. And again, it has headway for expansion because although Uniqlo has grown fantastically in the US, it really hasn't pitched up in a lot of markets yet. I mean, in Arizona, for example, we don't have one. We should have multiple. Now, they can't do everything at once. I appreciate they need to take the time. And again, they need to find the right location. But I think give it a few years, they will show up in more markets in the US. And that's going to be a big part of their growth story. I think Zara is more mature. They have done a lot of their expansion, but I still think they're a strong player. I think they have multiple formats they can push. But I think it's the back end of Zara that works. It's the production speed, it's the speed to market, it's the newness and innovation in the products. I still think it has a lot of resonance with the customer, and I think there's a lot of gains that they can make. So a bit more mature. I think the growth story is probably less impressive in the numbers, but it's a good retailer. H&M, quite honestly and bluntly, I don't like. H&M has done a lot of expansion, but I go into H&M stores. I don't like the look of the stores. I don't feel that the product is resonating as strongly as it should be, especially in the US. They are losing ground, I think, to the Zaras, to the Uniqlos, to the Primarks to a certain extent. They feel like yesterday's retailer, and I would want to see a lot more improvement in that front end proposition and the attraction of that for customers before I'd place a bet on them. I think they're in that category of being not a bad retailer, but they're a legacy retailer that really needs to refresh.
A little bit like Lululemon.
Exactly. And actually the stores are they're not the same, obviously, but it's that kind of stark, kind of industrial almost type look that just doesn't
It
it
is.
feels old fashioned.
It's those chrome fixtures that are just all over
Yes.
the place, and no,
Yeah.
no store architecture, no
Yeah.
topography that creates points of interest. I think they're both struggle from the same challenge.
Exactly. And you know, you as we were saying earlier, you need that cultural connection as well. And the store doesn't communicate that. It's still in the old era, I think, of fast fashion. You know, and honestly, Primark used to be a bit like that. You look at Primark's latest stores, they're nothing like that. They've got inspiration, energy, they're a bit boutique-like in places. They're using more displays, they have more texture, better lighting. They've learned and evolved over time. And I just feel H&M haven't. I think they're stuck in the past.
Let's take a quick break for a word from our sponsor, Leap, the retail as a service platform that lets modern brands launch and scale brick and mortar with far less cost, risk, and complexity. I know many of my listeners are thinking about or already in the process of opening retail locations, but the lease, build out, and hiring feel impossible. Leap handles everything from site selection and real estate to design, build out, staffing, and daily operations across 110 plus locations for over 55 brands in 13 U.S. markets. Brands like Bombas, Faraday, Frankie's Bikinis, and Ring Concierge have used Leap to run their retail, and with operational heavy lifting off their plate, they open faster, perform stronger, and scale further. If you're ready to go physical, visit leapinc.com to schedule a call and explore what a Leap partnership could look like for your brand. Let's talk a little bit about something that everyone talks about always, which is AI. There isn't a conference that you and I have attended where it doesn't consume the majority of the conference, the majority of the conversations, the majority of the vendors that are there. It's AI everywhere. That being said, where are you actually seeing, or what brands or retailers are you hearing are using AI, and how are they using it? And where specifically are you seeing AI make a difference in the way they are operating?
Well, I think where it's being used is for very technical tasks because I think it's very good. AI is very good at understanding large data sets and being able to tease out very good analysis and conclusions from those data sets in a technical sense. So, one of the areas where we've seen it, and it's not new, they've been using it for a long time, it's just been called slightly different names to AI, is with Amazon. I think Amazon has done a fantastic job of using AI and algorithms to understand where they need to place products. Now, obviously, they can do that with humans, but they have so many SKUs, so many nodes in the distribution set. They have so many moving parts that no human really or team of humans can do that job well. I think AI has been able to step in and say, look, you're getting 100 units of this product in. How do you distribute them between your main warehouses in the US? Where do you need to put them, and how does that vary seasonally? I think that's where it's good. And if you put them in the right place, of course, you have better availability for the customer. It costs you less because the route is much clearer to the customer, it's much more efficient. So you save money. And so you win on both sides. It's a better experience for the customer, it's faster, but it's actually cheaper. And that's a really strange thing because Amazon has become faster. We know that. They've improved delivery speeds enormously over the past 3 years. But I think what's also underappreciated is actually they've reduced the cost to serve. And that's a really odd thing. You would think faster delivery speeds, it costs more. It doesn't. It actually costs them less. And the reason it costs them less is because they've used AI to become much more efficient around inventory placement. And that to me is just a really great example of how it's driven gains in the experience of the customer, but it's also driven financial gains as well.
We often talk about AI around improving how the customer searches, how they query, the large language searches, the 28 to 35 word queries versus the 2 to 3 keywords, improving the shopping experience online. We don't talk as much, at least I don't hear as much discussion around what's happening in stores, technology in stores. What are you seeing out there that's improving the way customers shop in stores or the way retailers operate stores, which is so important considering that over 70% of the business still comes out of stores?
Yeah, I think it's a great point. So I think there's two dimensions to it where there's success points. I think the first dimension is the operational side. So I think investments in packing technology, investments in picking technology, even small automation in terms of the warehousing within stores to help online fulfillment, as Walmart has been trialing. These are all back of house. The customer doesn't see them, but I think they improve the efficiency of stores and they improve the way in which stores link with the digital ecosystem. Because the stores are a sunk cost. So if you can make them points of distribution, but you do it in a very automated way that doesn't affect the front end of the store, that's a great thing. So I think where we're seeing those kind of investments, it's very beneficial. I think from the customer side, look, the customer in store, I don't think wants gimmicks. An AI can be very gimmicky. I think what the customer wants is technology that helps them shop more effectively. So I think investment in things like apps to help the customer wayfind or navigate in store have been very, very helpful. Obviously, a retail like Home Depot has been great at doing that. I think Walmart has also been really good at doing that. Those are the kind of things that matter. And if you can link that, yes, I mean, if you want to use AI, you can link it to some kind of AI tool that helps answer your questions like, hey, is this item in stock? Or are there any other things that people buy that are in this store that might be alternatives? I think that's useful. People do that kind of thing when they're in a store. They often will search on their phones. That's where I think it's useful from the customer point of view. And if you can also within that pull in the customer data from other channels, like if the customer shops online as well, that's also useful because you can get a profile of that customer and you can use it to help them shop a physical store much more effectively. That's where I think it's really helpful. These things about AI robots and stuff, no, not so much.
I'm often surprised at there's so many good tools for improving the customer experience online that we haven't seen more of those tools come through into the stores. For example, if I walk into a store, Reformation, or if I walk into a store, Ralph Lauren, let's just say, and I pick a shirt and I ask the associate, what would be the best outfit I can build with this shirt? Show me two or three alternatives. You know, maybe select associates can do that, but an AI platform can certainly handle that. I mean, we know of many complete the look capability apps that are added to online experiences. I'm just so surprised that every associate in stores where styling is important isn't a stylist through a simple AI app. I'm waiting to see more of what's happening online come into the store space to improve both the associate and the customer experience. And to your point, not from a gimmick perspective, but just to get to the answer more efficiently, because time is always precious and valuable. I think I'm also in stores, the big investment, modern POS, obviously, like that's a given. Being able to complete a purchase of an online item and in-store item in one transaction, like why not? Of course, you have to be able to do that. And also RFID, I think just getting a really good handle on what my inventory looks like all the time is critically important. I think those are the big investments that we're going to continue to see. But then I also think, as I just mentioned, AI has got to come into the experience in a way that really adds to the basket size and improves conversion.
Yeah, I completely agree. And you look at some of the technologies that are doing that, like Stitch Fix now, where not only does it make outfit suggestions, but it shows what you, because you upload your photo, what you will look like in the products. I mean, obviously in a store, you can try stuff on, but sometimes you want to see multiple combinations of things. You don't want to try everything on. And an AI app can help with that. The same in home retail. A lot of people's time in a store, if they're buying furniture, for example, is often measuring things. How is this gonna look in my room? What does it go
Sure.
with? What's it look like with my decor? AI can definitely help in store with all of those different sort of customer decision points on the journey. And to me, it is a very sensible use because what you're doing is you're helping reduce friction for the customer, you're helping provide more information, and ultimately, you're probably helping the sales process as well, whether it be incremental things in the basket or actually converting the customer to buy that product. So I think it is a very important use case of AI. And as you say, interestingly, it does kind of exist in the digital tool set. So it just needs to be integrated in an appropriate way into the store tool set as well.
If you were sitting in a boardroom today talking to the CEO and the board members, What would you implore them to do relative to AI now rather than wait?
The main thing I would do is I would say experiment with things. I think it is an experimental technology still, and I think you need to have an AI strategy. You need to play around with things. But then I would say be careful where you place your bets. Don't do too much. Because I think, playing around and testing things in the small way is great. But if you're going to make a serious investment, you have to make sure it works. And when you're making sure it works, always think about the customer implication because we're in the business of serving customers. How does this help the customer? Sometimes it could be indirect because it might be, hey, this helps us improve stock levels and stock accuracy in stores. So therefore it helps sell through and sells conversion. It could be something direct, like the consumer tools we've mentioned in fashion. But I think you always need to reference it back to the customer because there's a lot of people with AI solutions to sell. There's a lot of people pushing AI as the thing of the future, and I think it is a very big thing in the future, but not all of the things that are being pushed are relevant or sensible. So I think the board's job, or the job of the boardroom, is to look and experiment with things, but then filter and say, okay, this is what we think is really meaningful for the customers in our business, and this is what we think could make a real proper difference, and let's invest in that.
Neil, before we close this out, just give us a little bit of perspective on the back half of the year. Just what you're looking for, some things that we should expect, and also be careful of. Enlighten, please.
I think our view at the moment is that the back half of the year will be reasonable. I think there's growth. Unless something exceptional happens, I don't see a collapse. I think what we're watching is margins and seeing how that plays out because I think there are a lot of costs in the system that need to come through. I think we're also looking at the polarization between winners and losers because we've had that for a while, but I think potentially the back half it really intensifies. And I think we're also looking at how retailers are approaching the season. Most of them have obviously planned already. But to me, what's interesting, there's a mix in there. Some are being super cautious on inventory levels because it goes back to that point about uncertainty. I think some are slightly more optimistic. So they've kind of committed a little bit more to inventory. And it's always that balance like, do we prefer selling out and selling everything at full price and maybe disappointing some customers and losing some sales? Or do we kind of want to place more bets? Maybe we have to discount a bit at the end, take some hit on margin that way. It's that balance of the two. And honestly, it's very mixed in the market at the moment. And I think that's how it influences the end results that we'll see as we go into the start of next year.
Great. Let's close this out with rapid fire. Who would you most like to meet?
Honestly, I'd quite like to meet Ronald Reagan because I think he was very good at communicating big ideas to people. And I'd like to understand how he did it.
One brand you would bet it all on.
I will say Marks& and Spencer from the UK. I just think it's great brand.
Favorite streamed show.
It honestly has to be The White Lotus. I just love the psychology and the absolute battiness of the whole thing.
Best store experience.
The best store experience is John Lewis, Oxford Street, but I'm gonna caveat it and say it's when I was about 10 years old and going there every weekend with my parents. To me, it was just the absolute mecca of shopping, and I just love that it was big, full of stuff, and you could just have a real adventure there. It's not quite the same as an adult, but it's still kinda magical for me.
And last question, favorite current retail CEO.
I I like a lot of them. I am gonna say Tony Spring at Macy's because I think he had one of the most difficult jobs. He has stepped into it and he has made a huge, huge difference. And I think it just goes to show how important, alongside the teams, because it is a team effort, but how important that person at the top is. And I think going into this, I was really skeptical that Macy's would change. And honestly, he has changed it, and he has changed the culture of it as well. So I just love what he's doing, and I just wish them all the luck, because I want to see that turnaround.
He's done an amazing job. And with that, we'll land this flight of the retail pilot. Neil, thank you so much for joining me today. We've spent some good time covering a lot of territory. Always a pleasure. Thank you.
And thank you very much for having me. I've really enjoyed this discussion.
Thanks for tuning in to this week's flight of the Retail Pilot. And please give us a review on your favorite podcast platform.